I wanted to go over what was going on in the crude oil market and show you how to use multiple time frames to again capture asymmetric reward. In this case, 6 times your risk. And it happened in very short order. So the first step is, recognizing on a daily chart that we're taking quite the beating. And, yesterday ticked just below 100. Today, we're well below that psychological 100 level. And as you look towards how the day is developing, you notice a divergence forming here on the 15-minute chart. So this first push down at 8:45, which is around Asian trading, got an RSI down here of less than 18. This push down here at 6:15 in the morning got us down to 24, which is a higher low. And as I was watching part of this form, my thought was 3 of these makes a really good divergence. And, this low was 93.54. So as soon as I saw that low go, and it only went by 1 penny, that got my attention. And, because I knew I was expecting one more down thing. It could even, been further. But in this case, it was only a penny. And then the chart really cooperated with us because that was made on this bar right here. So, you had this uptick in volume, kind of a final flush. If you were looking at the RSU method, this would have been your purchase point with a stop below here. You might have also noticed that the 1-minute chart formed a hoagie. So again, you've got this roughly 50-cent bar with 1, 2, 3 minutes inside it. And once we took off, there was no looking back. So in this situation, you're looking at a hoagie as an entry mechanism. It's not the sole reason for your trade. In a scalp, if you're using the hoagie for a scalp, depending on the context, you're really just looking to get this little bit out of it and you'd want to be out. In this situation, this was a setup condition, which could be one really good bar, could be a 2-bar pattern. In this case, it was a multi-bar pattern. That was our entry for the long side. Now, I want to dig further into this because there's something else really interesting. So we know that this is the low of the day, 93.53. We know it got rejected because the prior low of the day was 93.54. We barely got a penny underneath. Now, let's look at our U-turn dynamics. This happened at 10:27. Europe closes at 10:30, and typically you get a counter trend pattern. So whatever happened during European session, you tend to get some relief from that. And if we clean up these lines and go back to what we learned about U-turns, we can tell exactly where the U-turn was. And on a 1-minute chart, this was down, the last down bar. This is inside, so it's down. This is up. This is also up because it's inside. Up, up, inside, up. This high is 28, this high is 28, so this is also considered up because it's an outside bar. Then we have down, 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 up, up, up. So this is our very clean A, B, C. So getting above this level would be a U-turn and would confirm that this was the bottom, that this hoagie down here set the bottom. Right? So if you remember, our primary reason is this 15-minute divergence, 3-legged divergence, not just a regular old divergence. Starting from back here, we have that lower low, and then this lower low, all the while this making higher highs. Take it down to a 1-minute, and the bottoming bar created a hoagie that gave us an entry. RSU would have given us an entry. If you remember, RSU is taking the bar that went from below RSI below 30 to above 30, and then a close above the high of that bar is an entry with stop below that bar. So you had two different methods give you a low risk entry. And then now here at the U-turn, I'm going to show you something even more interesting. As this high was 94.50, we got back up and this bar touched 94.50, this bar touched 94.50, but it wasn't breaking. Now here's something interesting that you don't necessarily get to see every day. This is what it looked like on a 10-second chart at the time. So this was the first touch of 94.50, another touch of 94.50, 10 seconds, 20 seconds, 30 seconds, 40 seconds down, 10, 20, 30, 40, and you can see it kind of compressing there up against that 94.50. And, you know, in my mental model, that's basically a sell order at 94.50. People go up and fill some of it, come back down, go up, fill some of it, come down, go up, fill some of it. You know, someone tries to lean against it, but eventually that sell order would disappear and we would spike through, and that's what it shows on the second chart here. This is that same chart, and we can see 10, 20, 30, 40, 50, 60, 70, 80, about 80 or 90 seconds where that 94.50 held as a top, and then as soon as that order was depleted, we were able to break through that 1 minute U-turn. And all of that is this, you know, all of that in those couple of pictures is just this 2 minutes right here. And we had no trouble taking out that U-turn and continuing higher. So, you know, this being 94 to 93.50, 50 cent risk, we've gotten up to 97.50, that's 7 times your risk. You know, if a 1 minute chart is too fast for you, even looking at a 5 minute chart, there was also a hoagie on the 5 minute chart. And let's point out that hoagie right here with the rectangle. And it involves the same bottoming bar, but this is another way to go. This had a higher risk, you know, using a higher time frame like the 5 minute compared to the 1 minute gave you about 90 cents worth of risk, which you still, you know, up over 3 times your risk using that. And again, let's look at our bar counting now on the 5 minute, and notice that this is all one leg up, and then you had a 1 bar, 1 leg down right here, and we're still in this second wave up. That second wave up won't be you know, finished. Well, you know how it would finish if we take out the low of a previous bar without it being an outside bar. That's when I think we'll get a more protracted pullback. But until then, we're in rally mode on crude oil, and this is how you could have recognized the potential for the bottom to the penny, really, because all we were looking for was it to take out this 93.54. So as soon as it got to 93.53, our ears perk up, and we find you know, the lower time frame entry. Another thing of note in here, someone had asked about trading pullbacks using this method, and there was a perfect example on the 1 minute chart, and that would be right here after we had this little mini exhaustion. If we look at our and these lines here are Keltner channels, 2.5 standard deviation Keltner channels around the 20 period exponential moving average. If this is your final up bar, this is a down bar, this is a down bar, 96.19, 96.20, so that this is an up bar. And then this is a down bar, this is a down bar. So in a strong market that is riding above the Keltner channels, you know, in whatever time frame you're looking at, a two-legged pullback like this right to the EMA sets up another perfect low risk entry. So let's say everything up until now went too fast and you missed it. As long as you keep following what's going on, you will find more entries like this. This is a 30 cent entry from 96.21. 96.21, 97.62 is $1.40 on a 30 cent entry. Again, 4 times your risk right here on a 1 minute chart. 4 times your risk would have only gone to 97.40, so about here. So that's the power of watching the actual bars. And again, in doing this, you know that you can keep holding on because this isn't broken until the second leg on the 5-minute turns down. We have one leg, and all it could muster for a down leg was one bar that barely tailed below, which is a sign of strength. And then we have our second leg. So anyway, this is how you take kind of real-time inputs, and in this case, it was really just the 15-minute and the 1-minute. Markets are fractal, just like in our Forex trade, we look at daily against a 30-minute or a 15-minute, or sometimes a 5-minute. In this situation, we were basically playing a 15-minute against a 1-minute, and either way, it created an asymmetric return for us. So anyway, if you like this idea, drop a like, subscribe, ask me questions. Happy to talk about it.